AM Best maintained its stable outlook on the commercial line segment for 2019, supported by a number of factors, including the segment's overall strong risk-adjusted capital position, despite being impacted by record cat levels in 2017 and another active cat year in 2018. This is a testament to the segment's appropriate enterprise risk management processes and infrastructure, which continue to evolve and position the majority of commercial line companies well for managing changing market dynamics. Although AM Best has the opinion that the commercial lines core reserves remain modestly deficient, for the majority of commercial lines companies, their balance sheets remain sound and their reserves remain appropriate, largely driven by benign loss cost environments across the majority of the commercial lines, including workers' comp, the segment's largest line. However, there are exceptions to that. We're seeing continuing deterioration in commercial auto, driven largely by increasing loss costs, as well as some sublines within other liability, namely D&O and general liability. Although there are growing concerns over increased inflationary pressures negatively impacting loss costs beyond those exclusions, driven by pressures on social inflation, think of increased litigation and increasing jury verdicts, as well as just economic activity. We're currently operating at full employment, and there are growing concerns that this could have a negative impact on frequency of lost time claims within workers' comp as carriers or as employers hire less experienced employees, which will result in an increase in losses. With that being said, and it's worth monitoring closely, we anticipate that loss costs through the majority of commercial lines will remain manageable, including in workers' comp, over the near to mid-term. From the rate perspective, commercial auto and work comp continue to be outliers. Commercial auto continues to get significant rate improvement, and it needs to in order to offset what I mentioned earlier, increasing loss costs. On the other end of the spectrum, workers' comp, that has had year-over-year modest rate declines as competition picked up, as the overall profitability of that line continues to improve, largely by the benign loss cost trends within that line of business. We expect these trends within both of these lines to continue in 2019. But more importantly, we observed a growing number of casualty lines outside of commercial auto being able to get modest rate improvements. And this is a positive. We expect that momentum to build into 2019. If we start with just the abundance of capital, as I alluded to earlier, on one hand, that's viewed as a positive and strong risk-adjusted capital levels for many of the carriers in the segment. On the other hand, it can act as an impediment, an increase in competitive pressures and an impediment to rate increases. That, in conjunction with growing concerns around commercial auto, as well as concerns around inflationary pressures on loss costs in a number of commercial casualty lines, could negatively impact underwriting margins and overall balance sheets within the segment, especially if loss costs go well beyond what expectations are. However, for a number of reasons that I cited a moment ago, including the segment's strong risk-adjusted capital, appropriate ERM, and evolving utilization of data analytics, and other innovative technologies are enabling companies to react quicker and more thoughtfully to changes in market dynamics. That, in conjunction with our expectations that loss costs will remain benign across a majority of commercial lines over the near to midterm, as well as balance sheets maintaining solid positions, we feel that the overall segment remains stable over the near to midterm for commercial lines.